Did someone name you as the beneficiary on their IRA or 401k, 403b, or other retirement account? Now that they've left you the money, though, you may be wondering what to do. You could simply take the money now, but that can lead to huge tax implications. Did you know that rather than taking the money now and incurring the tax liability right away, you could open up a new account, a particular type of IRA, and roll the money into it, giving you the option of deferring taxes for up to 10 years. But it's got to be done just right. You're in the right place. By the end of this video, you'll know exactly what you need to know about inheriting an IRA or other retirement account. Hi, I'm Clark Atterbury, Financial Advisor with Atterbury Investment Management. Properly handling an inherited IRA isn't just about taking the money. It's about handling it the right way so it can benefit you and your family, potentially for decades. Whether you've inherited an IRA or just want to be prepared for the future, knowing the rules can mean the difference between preserving and growing your wealth or watching it be consumed by unnecessary taxes and penalties. Stick around, I'll break it all down for you. So what exactly is an inherited IRA? Simply put, it's a retirement account that you receive after the original owner passes away. But here's the thing, managing this kind of account comes with specific rules based on its type. Traditional inherited IRAs and Roth inherited IRAs work differently. If you want to learn more about the differences between traditional IRAs and Roth IRAs, I've made some videos on that. See the links in the description below this video. A traditional IRA will most likely require you to pay taxes on distributions. A Roth IRA could allow you to withdraw the money tax-free. This is a critical difference as it dictates your options going forward. Who qualifies to inherit an IRA? Typically, it's a spouse, a non-spouse beneficiary, or an entity like a trust. Spouses have the most flexibility. They can either create an inherited IRA or roll it over into their own regular, not inherited IRA. There are pros and cons to each option, depending, for example, on the relative age of the spouses. I've done a dedicated video on spousal IRA options. See the link to this video in the description below. Non-spouse beneficiaries don't have the option of rolling the old IRA into their own regular, not inherited IRA. Rather, they need to create a new account, a particular type of an account, an inherited IRA, to transfer the money into, and then follow specific guidelines for taking withdrawals. Trust beneficiaries come with their own unique rules and are beyond the scope of this video. Let us know in the comments below if you'd like us to make a video on that. Each type of beneficiary faces distinct implications. Understanding which type you are is critical. Now, let's review the rules that guide how you handle an inherited IRA. Managing an IRA starts with understanding the rules. For non-spouse beneficiaries, the 10-year rule applies in most cases. You must take the money out of the inherited IRA account within 10 years of the original owner's death. Also, if the person who left you the money was already required to take required minimum distributions, or RMDs, you'll need to continue those each year based on the deceased person's date of birth along the way. Spouses, on the other hand, have the option to take required minimum distributions based on their own age, or to delay distributions, or to treat the account as their own. For example, if you're a younger spouse, you might delay withdrawals to allow the account to keep growing. Knowing which option fits your situation can save you both time and money. Now let's look at how taxes come into play with inherited IRAs. For traditional inherited IRAs, distributions are treated as taxable income, which could bump you into a higher tax bracket. Roth inherited IRAs, on the other hand, generally allow for tax-free withdrawals, as long as the account was originally funded at least 5 years before the distributions begin. It's essential that you report inherited IRA income correctly on your tax return to avoid penalties. Talk with your tax advisor to be sure you get it right. If you inherit an IRA, there are immediate actions to take. In many ways, it's like rolling a 401k over into an IRA account. For more on that, see this video. The first step is to have a plan. Are you going to take the money now and just pay taxes on it, or are you going to roll it over into an inherited IRA? If you're going to roll it over, you'll need to know to what institution and what investments you're going to use in that new inherited IRA account. You'll want to open an account to receive the rollover. If you're a do-it-yourselfer, you'll do all that research, pick the institution, pick the investments, and handle the rollover yourself. If you're the kind of person who likes help with these things, that's exactly what we do, and we can handle all that for you. Reach out to us if we can help. The next step is to notify the institution currently holding the account that you're inheriting. You'll need to give them instructions as what to do with your inheritance, send you a check, or roll it over into your new inherited IRA. Finally, make sure you know the deadlines for withdrawals to avoid penalties. Taking these steps in a timely manner can help you be sure you meet the particular requirements and avoid costly mistakes. How can you reduce your tax burden? One strategy is to spread distributions over several years to avoid spiking your taxable income in any one year. Another is to time your withdrawals during low-income years when your tax bracket is lower. Working with a trusted advisor can help you balance all this so that you'll keep more of that money working for you and your family. Avoiding penalties and common mistakes. Avoiding mistakes is just as important as managing distributions. Missing deadlines for withdrawals is one of the most common errors and can lead to stiff penalties. By staying informed and planning ahead, you can minimize these risks. Now, let's briefly discuss how state laws might impact an inherited IRA. State laws can make managing an inherited IRA even more complicated. For example, community property states may have rules about spousal rights for inherited accounts. Additionally, state-specific tax regulations might influence your overall tax obligation. As always, speak to your financial advisor or tax professional to understand how local laws could affect your planning. As a side note, you'll want to keep all this in mind when naming the beneficiaries on your retirement accounts. Understanding how to manage an inherited IRA is critical to both preserving your wealth and to ensuring that you stay compliant with tax laws. Now that you know the rules, you're in a better position to make more informed decisions. For more on investment management and retirement planning, watch these videos next.